Yo, 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 how's it going, guys? So today we are gonna go over covered calls by special request. In fact, I've gotten a lot of special requests for, people in the group to ask me to do a video on covered calls. So here it is, right? There's a lot of hype around covered calls. Like, oh man, like I need to learn how to do that covered call stuff because, I hear all kinds of good things. It's like income, extra income, yada, yada, yada. Whatever, I'm going to go over all that today in great detail, okay? But before we get down to it, please, 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 if you're watching this video, hit the damn like button because I spent a lot of time putting this together for free for you guys to learn, okay? So let's dive in. All right, so covered call strategies. So why are covered calls so popular and why are novice traders so inquisitive about them, right? So let's just break down the main benefits here, okay? So basically what it does is it allows the investor to collect premium or additional income from shares they own, okay? What also it does is it helps provide additional protection and reduce potential losses on the shares that you are holding, right? Okay. The other thing it does is that you receive maximum benefit when the stock price does not move too significantly up or down, right? And honestly, the majority of the time, more times than not, you do see stocks go range bound for quite a bit of time, right? Especially after making a big move, right? Depending on the stock, So there is a lot of benefit to these, but, in my opinion, cover calls aren't something like panacea that you should be doing all the time. There's certain times when you should do them and certain times that you shouldn't, right? So I'm going to go over all that here in a minute. So what to know about them, right? So basically, if you've done any kind of research on your own on it at all, you know that it involves selling calls against shares that you already own, right? And you can do one covered call for every 100 shares you own, okay? So if you have, 250 shares, you can do two covered calls, right? So you'd be selling two calls against it, right? If you have 250 shares and, you just want to do one covered call, right? You just want to sell one monthly call and make an additional $500 a month off of those 100 shares and leave the other 150 naked and just let those run because you're still pretty bullish, right? You can do that as well. There's a lot of different ways to skin this cat. So when selling a call against your shares, what you're doing is you're giving up all upside potential above the call strike price, right? So if a stock skyrockets, like goes up like 10%, like Tesla has here recently, you're not going to benefit as much as you would if you would just ride those shares completely naked, right? You're going to give up some of that max potential by having those shares covered by the short calls, right? Now, you're still going to make good money on it, right? But you're not going to make as much as you would have if you would have just owned the shares outright. So keep that in mind as well. And again, it's not some golden strategy that's just going to start printing you money, right? But, there is a lot of utility to it. And there is a lot of flexibility to it. And it is a good strategy to use at certain times throughout the year, right? So, and like I said, there's good times to use them and there's bad times to use them, right? They shouldn't be your main or only strategy that you use blindly year round, okay? So, basically like when I use them the most is, when I think a stock is going to stay range bound, right, on shares that I already own, and after they've run up a lot, I will sell calls against them, right? I did it with Facebook last year after it moved up like, something crazy like 10% or something like that, which is a great gain on a stock that you're holding, right? And I started selling calls against it about a month out, and, there was one time that they got called away, but I was okay with that, right? Because I had already locked in a good amount of gain at that point. I was okay with them being called away, right? So you have to ask yourself, are you okay with them getting called away as well? Okay. How do they work, right? So, for example, you buy 100 shares of a stock at $250 per share, okay? And then you sell a 275 strike call for a 5.00 credit, right? A $500 premium, okay? As long as the stock stays below your strike price by expiration, you collect the full $500 premium, right? It's pretty good. Your maximum potential gain on this particular trade from entry is $3,000, okay? Now, how do I calculate that? So you calculate the max gain by subtracting the strike price from your current stock price and then adding the premium collected on that call, right? So we entered the 275 strike, right? So 275 minus the share price when you added it was 250, right? So 275 minus 250 equals 25, okay? And then you add that number to the premium you collected, right? So the premium we collected was 5.00. So add that on to 25, you get 30, right? Carry the decimal point over 2 times. That's $3,000 of max potential gain, right? So not bad, right? If it stays range bound over the next month and doesn't go on a rocket ride, you're going to make $3,000. I mean, if it does go on a rocket ride, you're still going to make $3,000. So still a good trade. The lower break even is 245. Okay, so that is the entry price minus the premium collected for the option, right? So if you added it when the stock was at 250 and the premium you collected was 5.00, you just simply subtract that from your entry and you get 245, right? So the best case scenario basically is that the stock moves up to 275 and stays there exactly at expiration, okay? You make $2,500 from the shares appreciating in value to 275, and then you collect all the premium from your short call, okay? And then you still own your shares, and then you can rinse and repeat the same strategy the next week for additional premium collection. Great outcome right there. Now, let's talk about if the stock goes on a rocket ride. If the stock rockets to 350, right, you still only make $3,000 because you have to sell the shares at 275, right? So you make $2,500 profit on the shares, and then you collect the $500 from the short call, and you make $3,000, right? But if you were holding the shares naked, you would have made $10,000, right? So this is what I'm saying. You're giving up max potential gain. You're giving up potential gain by doing this, right? So if you're really bullish on the stock, you don't want to do covered calls, right? Like if you're super bullish on the stock, it doesn't make any sense to do covered calls, unless you're kind of worried that it might pull back or it might trade sideways, right? Then slap that thing on there, add some protection, collect some premium, right? So in this scenario, you left $7,000 on the table on that rocket ride, right? Now, all this scenario is not very common. It certainly can happen and has happened to me a number of times before. And it's frustrating because you're like, why did I put those covered calls on there? And why didn't I just, leave it naked? But you just never know what's going to happen. So in the other scenario, if the stock goes to 245, you lose $500 on the shares you own, but you also collect $500 from the short call. All right, so here you break even, and then you can repeat the same strategy for the next week to collect more premium. Okay. Another example. If the stock goes to 240, you lose $1,000 on the shares, but collect $500 from the short call. Okay. If the stock goes to 200, you lose $5,000 on the shares, and you still only collect $500 from the short call. Okay. So, the point to the bullet point above is I want to emphasize that the covered calls aren't some panacea that's going to mint you money and prevent you from having big losses, okay? It's not the best strategy to hedge from big downside drawdowns in your shares, okay? You're still going to need to monitor your position for big moves down, okay? And you're still going to need to have an exit plan in case such moves happen, okay? some of you might be saying, well, I'm okay holding shares because I'm confident in this company, yada, 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 and I know it's going to come back. But you never know, right? If you bought Facebook recently, well over $300 a share, and you were selling calls against it, well, now Facebook, it traded below 200. It's just now starting to come back up to 200. Facebook, I'm confident it's going to come back, but it's like, how long is it going to take for it to reclaim those all-time highs, right? So you're really bag holding here, and you don't know when it's going to come back. And if we're talking about an even more skeptical, speculative stock like, Skills or something like that, those stocks are down 90% right now, and they may never recover, right? So you have to, think about all these things. So, like I was saying, it may never come back up to the entry price, or at least for a very long time. And you would have to collect a similar premium about 10 times just to break even on that original trade, right? Assuming it doesn't rocket one day and cap those gains or drop another 20%, right? Again, consider some stocks here recently that dropped by 80 or more percent. No covered call strategy in the world is going to make you money there, right? So, if you are really thinking you need to hedge your position and you don't want to sell it for, tax purposes or whatever, this isn't the best thing to hedge your shares, right? You can do, you can sell the calls against it, and you can grab like 20 delta puts like a month out, right? If you're expecting a little bit of drawdown, slap some puts on there, or do like a put calendar spread or something, right? Don't just hold on to them and bag hold. That's just my 2 cents, right? All this stuff again is just my opinion. Okay. What strike price should you select when you're doing these covered calls, right? So most people sell the 20 to 30 delta calls when they're selling covered calls. And the strike price you select also depends on how bullish you are, right? So the more bullish you are, the lower delta call you should select, right? I.e. the higher strike price, right? So, in that scenario above, you have a stock that's $250, and if you're super bullish, then you might want to sell the 290 strike call, right? But if you're only like a little bit bullish, you might want to pick like the 260 or 270 strike call to sell. Okay, higher strike prices give you a higher cost basis, right? So, what do I mean by that? If you have a stock that's $250 and you have 100 shares, right, that's $25,000, right? And then if you sell a call that is worth $1,000 in premium, your cost basis is $24,000, right? If you sell a call that's only $100, then your cost basis is $24,900, right? So a higher strike is going to give you a higher cost basis, okay? A higher strike also gives a greater max profit potential as well, right? So in the scenario above, where I talked about the 250 shares and the 275, the max profit was about 3,000, right? If you were to do the like 290, then your upside potential on those shares isn't capped until you get to 290, which would put you at about $4,000 profit, right? Plus whatever premium you're collecting, okay? So if you're extremely bullish, then, like I said earlier, why would you sell a call in the first place, right? Have a little bit of patience, let it run up, and then slap a short call on it, okay? And whatever you're using for those target levels, if you're using TA, you can use, Fibonacci extensions or moving averages, support and resistance, right? Just, again, my opinion, wait till it moves up. If you're bullish, wait till it moves up to that target level that you had, or when it starts getting close, then slap that short call on there. Then if it chops around at that resistance level or gets rejected from it, you're going to make money or be protected from the pullback, right? The lowest delta that I ever use is about 20 delta, okay? The highest delta that I've ever used is about a 50 delta, right? I've seen people use like 60 deltas or more. I don't really, I don't really like that strategy, but everyone does their own thing, right? There's more than one way to skin this cat. And again, like a 10 delta, if I'm doing a 10 delta, like, if I'm that bullish, just hold on to the shares. Like, it's just, to me, it's not worth it to collect premium on a 10 delta call. Like, sure, like you have a 90% chance that you're going to collect all the premium on that. But, again, to me, it's a waste of my time. Just my opinion. So like I said above, you can use TA to determine strike prices as well, placing the short calls at resistance, Fibonacci extension, etc. So sometimes I will add an at-the-money short call after shares I own run up to resistance, like I was saying above. So if I own Apple, for instance, and it runs from 160 to 170, and 170 is a resistance level, right? I can sell monthly at-the-money calls for about $500, okay? So I will make more money by doing this way than if I would have added the 170 calls when Apple was at 160, right? Because those same calls would probably only be about $200, okay? Now, if Apple pulls back, I'll have more protection and collect more premium, okay? And if it keeps running, I'll still make an additional $500 compared to if I would have just sold the shares when it hit 170, right? So instead of me selling at 170, right, and just locking in all of my profits, what I'm doing here is I'm allowing for the potential to make another $500 even if it keeps running, right? So, I'm making an extra $500 basically. It also is adding protection on the downside to 165, right? So my window of optimal, optimization is like 165 to 175 now, right? So like if Apple stays between 165 and 175, that's kind of the sweet spot for me here, right? I don't really care if it keeps running because, again, I was already happy with it hitting my target, but I'm just slapping a short call on it just in case it runs up or just in case it pulls back, right? It adds a lot of flexibility. And I do this with regular long calls as well, not just shares. So if it stays below 70, I can keep repeating this strategy as long as I continue to think Apple stays range bound, right? Again, I'm assuming it's staying range bound or I'm expecting a small pullback by doing the short call, right? If I think Apple's going to keep running to 185, there's no point in me doing a short call here, okay? That's just my opinion. Okay, so what time frame or what expiration should I be looking at, okay? So some people use as short as a week or as far as 60 days to expiration. I think anything longer than 60 days out, in my opinion, isn't worth it, mostly due to the time decay acting too slow this far out, okay? I generally don't do... What is going on here? I generally don't do less than a week to expiration because the premium isn't as high unless Ivy has like really spiked, okay? Me personally, I mostly stay in that 2 to 4 week range, okay? This is just where I found the biggest bang for my buck, okay? Again, this is just my personal experience and just, what fits my strategy the best. I know other people do it different ways. I'm just kind of giving you guys what has worked best for me, okay? Now, how do we manage these, okay? So you can hold the position until expiration and try to let the option expire worthless to collect the full premium or let the shares you own get called away, okay? I usually don't do that. Again, just my personal preference, my particular strategy. I usually buy the calls back when they've reached about 75% profit. I usually never let them go that high. I may buy them back as soon as 50% profit or even less, depending on what I'm seeing on the chart. Again, my opinion, there's no point in holding them past 90% profit Because why hold out for the remaining 10% when you're risking a lot more than what you can make from there, right? So I've seen calls go from 90% profit, short calls that is, or long calls, to over 100% profit or more, right? Like Square or Baba this week, the week of 318. I actually had a Square call that I had actually slapped a 135 short call on it, and the 130 call went down like 95%. Well, that thing ended up just ripping and going in the money, right? So if you were holding shares and you had that 130 short call and you didn't collect profit when it was up 90% profit, shame on you, because that thing went deep in the money on Friday and those shares would have got called away, right? Now you still would have made good money on it, but you kind of didn't maximize your own potential profit just by not adhering to that strategy that I adhere to. So again, just my opinion. That's what I do. So I also recommend setting an alert below support, right? So at this point, you can consider buying back the short call and possibly cutting your shares if the chart is starting to turn to bearish, right? Now, again, this just depends on your own personal trading strategy and your time frame, right? But to me, there's no point in continuing to hold the shares and keep trying to sell calls against it if the chart is really bearish, right? Unless you are really confident in this stock and plan to hold for the long term. But even if you're confident long term and don't want to sell your shares, then why not hedge it with a better hedge strategy such as naked long puts, debit spreads, calendar spreads, something, right? Like a short call has very limited max profit. It's not going to protect you on a big drawdown, right? Like we had here in January and February, right? A lot of people, some of their portfolios got murdered because they weren't hedging properly, okay? And if you only put short calls on your stocks, then, you weren't hedged very well either. So what stocks should I run these on, okay? Me personally, I like to do it on higher share prices. You don't have to. I generally don't run them on stocks below $50 a share. Again, this is my personal preference. You can absolutely do them on $10 stocks, but usually stocks under $50 aren't going to give you more than $50 for a monthly 25 delta short call. But more important than that is the actual implied volatility, right? And I'm going to go over that in a little bit more detail here in a second, because implied volatility really is the most important aspect of this covered call strategy. And I'll show you why it doesn't matter if it's like a $50 or a $10 stock. So the higher implied volatility, the higher premium you'll collect, okay? Generally, I like selling calls if IV is higher than 50%, okay? And especially if IV rank is greater than 50. And if you don't know what IV rank is, look it up. But it's basically where IV is for that particular security throughout the year, right? Whether it's high or low. If it's above 50, it's higher than it is on average, basically. So let's take a look at Charge Point Holdings, CHPT. I looked at these on the option chain here a couple of days ago. So these are all pretty accurate, right? At the time I was looking at this, CHPT was at 1844, and the 21 strike monthly calls were selling for 50 cents, okay? IV was 71% on those, okay? So it's fitting my criteria. It's over 50%. 1,000 shares would be about $18,440, okay? So if I am running covered calls on all of those, I am collecting $500 in monthly premium on those shares, okay? So if CHPT stays range bound, which this is actually one I am kind of running some covered calls on right now because it did have a big move up and it is trading sideways a little bit right now, and I'm expecting it to consolidate for a little bit longer, right? The premium on this is 2.7% of the share's capital. Okay, so the $500 that you're collecting is 2.7% of 18,440. Okay, and that number is important to me. Baidu, 149.04 per share at the time I was looking at this. The 170 monthly calls were going for 4.00, right? And all of these calls I'm looking at are the same delta approximately, right? I'm looking at 25 deltas for the monthly calls. So 100, and that was 71% IV as well. The 100 shares of that would be $14,900. So in all of these examples, I'm using about $15,000 to $20,000 in capital. So you're collecting $400 in monthly premium, and that is 2.68% of the share's capital. Okay, so good deal to me. Square, 140.64, right? That was the one I was talking about. It just ripped on Friday by over 10 points. The monthly calls, 160 strike, selling for 4.00. IV is 74%. 100 shares would be High Fury. That's my dog. Premium is 2.8% of the share's capital. Space, SPCE, real garbage stock, but it's ultra high in IV, right? 9.43, 11 strike monthly calls for 34, and the IV is 87, right? $2,000 or 2,000 shares would be about $18,860. So in this one, you'd be collecting $680 in premium. Okay. The premium collected would be 3.6% of the share's capital, right? So now let me just briefly talk about why I generally don't like doing covered calls on stocks like SPCE, right? These low cost, $10 stock price covered calls. So for something like SPCE, these things move a lot, right? Percentage-wise, they're lower cap stocks. Not uncommon for SPCE to just drop, 10% overnight or rocket 10% overnight, right? So they're just a little bit too erratic for me to be running covered calls on. Like, yes, I'm going to collect a good amount of premium on them, but, again, like the covered calls aren't going to offer me a lot of protection on the downside if they do have one of these big moves down. Or it's also, not going to, I'm going to leave a lot on the table if it rockets up. Now, granted, if it does go up in this situation, I'm going to make $2,680 if it goes way past my strikes, right? So I shouldn't be complaining, but it's just not something that fits my strategy well. Maybe it fits your guys' strategy well. That's up to you, right? You're going to adopt your own trading strategy. I'm just offering you my 2 cents. So let's talk about KO, Coca-Cola, 60.10. The 62.50 monthly calls are going for 30 cents. So you notice how close that is to the share price. The IV is 18%. Coca-Cola is quite the boring stock. It doesn't move a lot, right? So as you can imagine, you're not going to collect a lot of premium on them. So 300 shares would be about $18,000, and you would collect $90 in premium on that, right? So the premium is 0.5% of your share capital. It's, to me, that does not fit my criteria, right? Like, I like to be around 1 to 2% of premium collection on those monthly calls, right? So the premium to me should be between 1 to 2% on those monthly 25 delta calls, right? So I'm looking for 1 to 2% in premium of the shares, right? So in this scenario, 0.30 is 0.5% of 60.1, okay? So not something I would typically do covered calls on, right? Now, Coca-Cola pays a good dividend, right? Nah, I don't know it off the top of my head. Maybe like 4% or something like that, right? Now, I do know some people that are like, well, why not run covered calls on Coca-Cola year round? Because, you're not likely to get assigned, or you're not likely to have them get called away, and you'll get an extra 5%, right? Like, I don't know. To me, it's just not worth my time. Just my opinion. Again, you guys can choose to do that year round, and maybe you'll make good money doing it. But I'm just letting you know what has worked for me in the past and what fits my particular trading style. Okay. Apple 164. The monthly calls, the 170 strike calls, are going for 180. Okay. The IV, surprisingly, on Apple is only 23% IV. 100 shares of Apple would be $16,400. You would be collecting 180 in premium, and it is 1% of the shares capital. Okay, so that just barely fits my criteria here. Okay, so that's kind of the breakdown there on stocks that I like to run them on. Just look for what I look for is 1 to 2% of the share price, right? You can certainly look for more than that, right? But like that's minimum to me. Something like SBCE, if you see something that's a higher price and it has, over 3% of the shares capital, 100%, I would do it, as long as I'm relatively bullish on it, right? Okay. So kind of wrapping up near the end here, that kind of covers all of the basics on the covered calls. But this was a special requested add-on by one of the members. So do I have to own shares of the stock to run a similar strategy, right? The short and simple answer is no, right? So if you don't know what I'm talking about, look this up. But you can run what's called the poor man's covered call, aka a diagonal spread. Okay, so basically what you're doing is you're using a long dated option that's at least 2 months to expiration. Okay, and you are selling calls against it with 1 to 4 weeks to expiration. Okay, and there's actually less downside risk with this strategy than doing covered calls on shares, because your max loss is limited to the total premium, right? Whereas a stock can go to zero. So these generally are long theta and make money when a stock stays either range bound or moves up. So you have a big window of profits, right? I use these a lot on my leaps plays. Especially if you have 20 delta leaps that go to like 50 deltas, so they're at the money basically, then I will likely be out of half of my leaps, and then I'll start selling calls against those leaps with 30 days to expiration, 20 to 30 delta short calls. And I do this quite frequently, and it's a pretty successful strategy for me. So I encourage you guys to at least look into it, and consider adding it to your trading routine. So conversely, you can do leaps that are like a year out at 50 delta, so you can get right to the punch and sell 20 delta monthly calls against those, which is essentially giving you a net delta of 30, right? So for leaps, like you don't want to do covered calls on leaps that are, ideally like 50 delta, right? Like anything lower than 40 delta, don't do covered calls. Don't do poor man's covered calls on leaps that are like 40 deltas. Like, to me, again, just not worth it. You can do it, but you really want those strikes closer to the money on the long strikes, okay? For a number of different reasons, right? Theta, it's just, to me, not a good idea to run them at 40 deltas or lower. Okay, you're getting a better bang for your buck by running like 50 or higher deltas. Okay, so as you can see, there's a lot of different ways to structure this kind of setup, and it offers lots of flexibility. Okay, So I'm going to cover this topic in more detail in another video where I go over diagonal spreads in detail and why I like them so much. Like diagonal spreads is another one similar to calendar spreads that I do very often. And it's also, again, one of my more profitable strategies and one that has the highest success rate for me. I like to do them with Tesla a lot. So, again, it just offers you a lot of flexibility, right? Let's come over here to Tesla real quick, and I'm just going to show you real quick. So let's say you want to do some poor man covered calls on Tesla, okay? So I don't want to spend almost $100,000 to buy 100 shares of Tesla. So what I can do is, now these are still going to be expensive, mind you, but what I can do is I'll take these 1,000 strike calls for January, and let's look at April 22nd, which is right before the earnings, right? Let's be careful about that because I don't want it to cover earnings because IV will ramp up a lot on these. I want time decay to be as max as possible. So let's go to the 25, that's 11.30. So that's about a 21.30 premium. So this is still, it's going to cost you $19,579 to enter this trade, but to me, it's a really good strategy. So let's go over here. Theta is 55, so you're going to be making $55 a day on this. Bega's 2.54. Delta's 35. So this is basically like owning 35 shares of Tesla. That'll go up as you get closer to those upper strikes. Let's look at the risk profile. So the break even on the downside is 969. So as long as it stays above 969 by expiration, you're going to make money, right? The max profit on this is over $10,000, okay? And that's basically Tesla running to 1130 by April 22nd, which is very possible. The market's looking pretty bullish right now, and Tesla has earnings that last week of April, and Tesla very often runs up into those earnings, okay? So, yeah, that's basically all I wanted to cover today in the covered call educational video. If anyone has any other questions or any other things that you want asked about covered calls, leave me a comment. Leave a question in the comment section, or head on over to the Discord, and I'll ask in there. I'm here 24/7 for my members that have any questions relating to any kind of trades or option spreads. So hope you guys found this video valuable and can learn from it and apply it to your own trading strategy, or modify it to fit you a little bit better. So that's all I have for you guys. Hope you have a good rest of your week and a profitable March. All right, take care.